Hey guys, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 8th, 2018. Yes, another video. I've done quite a few recently, and the reason for that is this is by far, without even a close second, the most important point in the market, a potential inflection point. We have key uptrend lines, not just on the daily chart, but on the weekly charts, primary uptrend lines that are being challenged, a couple that have been broken, and again, if there's ever been a time to closely monitor the technicals, it's now because the next couple, like week or two here, have the potential to make or break this market. I've been saying for a long time we're going to see a healthy correction. Bear market probably a drop of 20% this year. And the big question is the million-dollar question: is it now or does it come a little later? I've laid out my scenarios already, my primary scenario, my preferred scenario, what I'd like to see. However, I've also mentioned that I'm keeping it light because anything can happen. And most importantly, as I covered in the video today, and I've been stating on the site, after a big move like we just had in the markets, um, it is almost a guarantee that you're going to get what we've seen here, this choppy price action. So as I've said, keep it light on swing trading. You're going to get these choppy moves. This is indicative of what you get in the wake of a big move. This is what I always refer to as letting the dust settle. And the point being, if you put on a swing trade, unless you're going to allow a huge stop, um, you're probably going to have that stop run. I use the example today. You buy a $100 stock, you think it's going to 110, you put a 3% stop loss order, you're going to get taken out more than likely, even if your trade pans out in the right direction. So you have to let the dust settle. Right now, the market's trying to digest the big drop. And again, this is just typical run-of-the-mill post sharp sell-off, mini crash, whatever you want to call it, noise. Rarely do you see, or if ever, a drop like this followed by very steady, calm market. You usually get a sharp move in either direction. So enough of that. We've seen that. That may continue to play out this week. So my point is keep it light, but keep an eye on the technicals because what I'm looking at is, uh, the next, where's the next 10 to 20% move in the market? And I think the charts can tell us that. So what I'm going to do in this video is break it down and just take a look at the sectors in the S&P 500. There's only 11 sectors, so we'll just look at the sector ETFs. Very simple, relatively quick video because the stock market is simply a sum of its parts. And the S&P 500 being really quote unquote the broad market, the most diversified um, index out there. It's the 500 largest companies representative of all the majority of the sectors in the U.S. economy. So we'll run through that. And again, uh, I don't know. I'm just trying to say don't be freaked out by these, 1, 2% up days, 2% down days. This is noise. We may undercut those lows, as I said. Heck, we can collapse from here. Like I said, I'll show you targets on the market, which are, I think will be hit this year. They're 20% lower than where we're at today. That's where I think the next big move is. However, are we going to go to new highs and rally before we get there? In other words, is the bigger correction coming, weeks or months from now, end of the year, maybe even in 2019. That's possible. So you got to be careful here. Let's take a look at the charts. What we're going to do is go into the sectors. You can see. Well, let me actually fix this for. Okay, here's what I wanted to show you. I wanted to include, this is a watch list I set up a while back that has the 11 sectors of the S&P 500 in there, and I also have the weightings of each sector. We'll go through those. But to start out, what I'm talking about is, for the first time in a while, we have this primary uptrend line. This was the primary uptrend line for the bull market off the March 2009 lows, which was broken back here, and we had a period of consolidation. Some consider that this a bull market, this a bear market. At the very least, it's what you call a deer market. You probably never heard of that term, but if you look up the term deer market, it's a market that trends sideways for an extended period of time. So as you know, bull markets are when the trend is up, bear markets when the primary trend is lower, and this was a nearly 2-year deer market here. And so some consider this, when we broke out of that top of that range, the start right here of a new bull market. And certainly by, whatever metric you want to use, the traditional metric of a bull market is a rise of 20% or more. From that low on that deer market range there, it went up. This one was almost 60%. So certainly a bull market in itself. But again, the primary trend since 2009 has been up. And most importantly, this is the uptrend line off that low back in early 2016. It's very well defined. And as you can see, in just 2 weeks, we've dropped down to that level. And as I talked about it, we undershot it last week on an intra-week, I'm sorry, this week. Earlier this week, we undershot it on an intra-week basis. And as I said, the only thing that matters when trading on a weekly time frame are your weekly candlestick closes. So that's Friday at 4 p.m. Now, if we closed, just a hair below here, does that mean we're going 20% lower? No. But if you see an impulsive break and an impulsive weekly close, especially two weekly candlestick closes below this trend line, that's a pretty good chance that we are headed lower. A lot of bearish developments in the technical. We have a high level bearish PPO crossover, the first one in a while. The last time I see a clean bearish PPO crossover was back here. We had one back here. So uh, the bull case here, if we are going to bounce and match or take out these highs or continue on with this great bull market, the potentially good news is, as I often say, corrections can happen in one of two ways or a combination thereof. They can happen in time, like for example, right here, we had a drop of about well, let's see if I can grab the highs. Yeah, about 5%, but these are weekly candles, so that took a few months to get there. Here's the even bigger drop. This drop was, a good 15% or more, and that took 4 months to do so. Now we've had a sharp, very sharp drop from high to low so far. It was almost 10%, fell a little shy of that 10% official correction mark, but it only happened so far in less than 2 weeks, these two big red candles. So what I'm getting at here is we were extremely overbought, negative divergence, trendline breaks, everything. This was priced in. We saw it coming in advance. When we got the sell signal a few weeks ago, those were highlighted. And to look at the glass half full here, we can say that the near term overbought and extreme bullish sentiment and everything else, all those conditions have been worked off with a correction in price, a very swift correction, because it's a drop of almost 10%. So that's the glass half full. But again, all these extremes, where we're at in the cycle, this is the longest or second longest, it's been the second longest bull market in history. I have to look back and see if we've now exceeded this. And I think I heard recently there's never in the history of the U.S. been an economic expansion that has lasted more than 8.5 years. I think we're either at or past that number. So um, you can argue all you want, but I think it's safe to say we're in the ninth inning of a bull market, and we could be, at the top of the ninth here. Hard to say, or where we're at exactly, but let's see. All right, enough on that. Let's look at the daily chart, and again, remember that this is a critical level. Watching these weekly trend lines here, just like when we finally got the break. You see there, we limped through it and then an impulsive break and solid close below, and that was followed by a lot more downside, and not just on that initial thrust down, but again, and this maybe is something like we get here. We see we broke that trend line, had a similar move down, a little sharper, bounced back to roughly challenge those previous highs, fell a little short, then went down and tested the lows again. So, this is one of my preferred scenarios right now. I'd love to see a little, especially to take out those highs, put in a divergent high, and then move on. And again, daily chart, everything I've talked about here, we're challenging that trend line again. This is a daily time frame, so what happens intra-week is not as important as what happens at the end of the weekly close on that weekly chart we were just looking at. There's another cleaner version here. So there it is. So bigger picture, a lot of noise back and forth. Now let's just dive into the sectors, and then this will give us it might give us some additional insight to where we're going. And what I'll do is I'll start with the sectors with the heaviest weighting in the S&P 500. Okay, the first up is XLK. XLK, by the way, has a 24.2% weighting, so by far without even a close second. Financials come in at just under 15%. So this is one quarter, one fourth of the returns of the S&P 500. It's a lot more of the Nasdaq 100. I think it's roughly half. So tech is everything. Tech is important. And let me go back to that board I was on just now. There's a couple boards I have here. This one shows it pretty clean. Roughly we've been moving up in this ascending price channel here. You can move this line up if you wanted to do that. Either way, you can see a price channel, but the upper line doesn't matter as much. Let me get that out of the way. And that was a midpoint line. This is the trend line. It's very well defined, just like those in the stock market. No coincidence either, because as I always say, XLK and QQQ almost perfectly mirror each other if you overlay those, because the QQQ, the Nasdaq 100, is so tech heavy, and even the S&P 500. Most of the top components are your same FANG stocks that you have in the Nasdaq 100. So tech is important. Negative divergence, a divergent high, which tells me it's only a matter of time before this trend line breaks with this daily, negative divergence. Big question is, we dropped a lot. We're pretty oversold. We went from overbought to oversold in just a couple weeks here. So the question is, does this trend line hold or not? And on a daily basis, daily close would certainly be bearish. We had an intraday break there, but it was a stick save, very strong reversal back up. We're testing it again, and we may undercut it again. If we close a little bit below it, limp below it, that's not the end of the world. But if you see a smash below there, an impulsive daily close, and then again, look at the weekly chart. If you see that go on the weekly closing basis, here it is. Here's XLK, extremely overbought. This is the primary uptrend line off the mid 2015 lows, very well defined, and we're dancing on it now. So, like I said, this is, well, without a doubt, one of the most important times that in the markets, technically speaking, because it's not just XLK. As I'm going to go through these components, you'll see a lot of the key sectors are at key trendline support. XLF financials number 2, 14.9% weighting in the S&P 500, so also a very important sector. They're pretty comfortably above trendline support. This is a daily chart here. Let's look at the weekly chart. You can see the negative divergence there as well, and you can see it here, divergence, extremely overbought. So here we are on XLF, and you may want to replicate these trend lines. Keep in mind, I always use log scaling. I feel that is very important versus arithmetic scaling. You get a better, more accurate picture of the price action, because log scaling will put the candlesticks in proportion to their percentage moves, not their point moves. So there it is. We have a little room to go before the financials break support, so they're still above trend. And again, I guess if there's a common theme here, besides the fact we're at a very critical, important point in the markets, technically speaking, it is that we're still above trend, that we haven't broken support. As ugly as the price action has been in the last few days, last week or so here, we're in a primary bull market. All the trend indicators are bullish. And, we've had several times in the last few years where it looked like we were going to get a real deal, a breakdown of one of these trend lines, like back here, and it never happened. So maybe we bounce again, and I'm leaning towards that one more bounce before we break, have a solid and sustained break. And then when we do, this is where I think XLF is going before everything is said and done, at least the initial longer term swing target. And from where we're at now, I have to grab right where we are. That's a drop of about 17.3% in the financials. I would expect a bounce there, and then ultimately a move down here to about 2087, and that would be a drop of about 24-25% from where we're at. And I do think that happens in 2018. All right, that's XLF. Next one up would be healthcare. XLV. That represents 13.9, so right around 14%. There we go. Chart needs to load. There it is. Healthcare is doing okay as far as their trend line, at least the way I have this draw here. Sometimes I'll revise my draws on the trend line. You could put a smaller, what I call minor trend line there, and that one's broken, but I think we'll catch support here at this trend line. I'm on the weekly time frame now. Guys, I'm jumping back and forth between the daily and weekly, and if I don't make it clear, just look up here in the upper left-hand corner. You can see which time frame we're on. So there's XLV Healthcare. broke that minor trend line, has some other trend line support here. Let's look at it at the daily chart. Again, almost about a 14% weighting. There's pretty decent support here, horizontal support that it's fallen to. You can see a lot of reactions starting here. Two reactions from below, then we broke out. That was bullish. We back tested that level several times. So this is the big number, in my opinion, for XLV, for the healthcare sector. Um, we have some cross currents. Yeah, I can do the glass half empty, the glass half full thing here. There was a pretty well-defined uptrend line that was broken. We hit support, we jumped up, we back tested, so that was an objective short entry on the back test, and so far we've fallen back down. That's it. If we break this, next significant support levels all the way down here around 77 or so. And if we do that again, when you start to see the support levels on the daily trend lines break, you need to move out to the weekly chart and look at those more significant levels, because this is where the world of the trend traders and the investors, your 401k money, your long-term funds, swing traders, really trade off the daily and 60-minute charts. At least that's how I do it. All right, next up, that was healthcare, consumer discretionary. That is XLY. You have a 12.6% weighting, and here was a pretty well-defined uptrend line. We had a little blow off top. The New Year rally really took this one up, and then boom, near vertical plunge right afterwards, wiped out the New Year rally. And again, I keep saying this, the technicals work so well, so much better versus those slow trending markets where you don't have a lot of price action going on. When you get this volatility, the charts really start working well to the technicals. So in this case, you see a breakdown. The next day, you saw a big reversal, a back test. It stopped right around there. And again, I talk about a lot, when you have a tremendous amount of momentum and velocity heading up or down, you tend to get these overshoots. So the fact we closed that candle a little bit above the trend line only makes sense, because you had a tremendous amount of upward velocity on that candle, because we had reversed down here from the lows and swung 5% on that one. Next day, we tried to regain it, failed, closed right back on the trend line, and now we're below it. So another way to put it, this is basically, if you tune out all the noise, a break of trend and a back test. Successful back test that's failed, moving lower. Where does it go from here? Well, unless the market can giddy up and turn around soon, we're probably going to come in and test this 98.60 support level and then bounce. That's the daily chart. Longer term, if that level goes, there was a sideways trading range back here from early 2017 to almost to late 2017. So if you put a trend line at the top of there, that's support. That would be a longer term target around 92.50 or so. We look at a weekly chart. XLY, this is the trend line that I'm using, has a lot of reactions starting back off around 2011, and we're still comfortably above that trend line. So again, XLY has ways to go even before it hits trend line, and it would probably most likely have a reaction there, a test. So I can see a little bit of downside before a bounce there in XLY. There's also some horizontal support right there around 92.50 or so. And then you can see my other lines on the long-term chart. All right, next one up, with that consumer discretionary. So next we'd have industrials, and that's XLI. And we'll start here with the weekly chart. Here's the industrials. There was a primary uptrend line off the 2009 lows, broke. There was that deer sideways market. In some sectors, and even some major indices like the small caps, it was a bear market. It dropped over 20%. But since then, we have, like everything else, a well-formed uptrend line, and XLI is testing that now. Like the broad markets, it overshot it intra-week earlier this week, but we've regained it. We're above it. So again, my common theme here is do what you want, but we do not have major sell signals on the broad market yet. We're dancing right at support. And Trading 101 says you either, if you're bullish, you go long at support on pullbacks to support during an uptrend, and if you're bearish, you wait for a break of support to short. So we don't have on at least on this one yet a sell signal on the longer term, on the weekly time frame. Daily, This is a busy chart. It just shows you I don't have it all marked up here. I don't have the divergences drawn, but you could kind of fill that in yourself. Each of these peaks here, we had divergent highs, corrections, divergent highs, correction. Most recently, we had this bearish rising wedge pattern with a divergent high, broke down, very impulsive sell-off, but we caught support. And again, that's my theme. That's why I think this market, it's looking ugly, but I do think we get a bounce here because we had a pretty sharp correction in short order, and a lot of sectors have come down to both trend line and or price support. Again, you can see the primary uptrend line right here on XLI. You can see that horizontal support level there defined by this reaction high, a breakout here. So there's another one at support. If that support breaks, that's actually dual intersecting support levels. You can see my next support level down here. And again, if most importantly, if we start to break down on those weekly trend lines and we get some follow through, but I still favor another thrust up before that happens, and that thrust could last weeks, if not months. Next up, that was industrials. What do we have now? Staples, I think. Yeah, consumer staples at 7.9, so we'll call it 8%. This one just took a beating, got the snot knocked out of it in this recent correction. We had a divergent high. Again, all of this was priced into the charts. This wasn't just a random drop out of nowhere. I mean, the media will pin it that way, but these were charts and trend lines that I've been covering. There's XLP, divergent high, steep negative divergence, and that's what you had back here. I'm using a different chart layout that I didn't have all the drawings marked up on this chart like I did on my primary layout. But you can see we had a divergent high here. You had a divergent high back here that goes to the left of the screen. And, simple yet effective. Divergent highs warn of impending trend changes. And that's what we got. As you can see, these were pretty sharp, significant corrections, but they took a while to get there. Actually, this one started with a sharp bang, not nearly as much as this one, had a little kickback rally. And that's the other thing I'm looking at, guys. Usually you get initial sharp bang, you're going to have at least one decent kickback rally to retrace, maybe 30, anywhere from the 30, 2%, 38.2% fib retracement up to the 36, somewhere around there. So for example, on XLP, um, I don't know if this one's going to make new highs. I'd love to see new highs in the broad market, but XLP, I can tell you if it bounced back to 56.43 and the charts confirm, that might be good for a swing short trade. And you can even go long here. Like I said, you can go long in the broad markets with stops somewhat below the recent lows. And you have about a 3% downside risk to that. And if the markets go on to make new highs, even just a marginal new high over the old highs, it should pay off pretty well for you. So that was XLP. Did I already cover it on the day weekly? No, I don't think I did. Let's see. I haven't marked this chart up in a while. I had a trend line right here. Slice through it a little. Let's color that one up. Yeah, this one I don't have a very well-defined trend line. So what I'm looking at here, let's just look at these horizontal price levels. These are key levels to watch. And they're also targets on the downside. Uh, if the top is in now or if the top is in soon. And again, one of the stories here too is we had negative divergence, not just on the daily time frame, but all the way out on the weekly time frame, which indicates a more lasting trend change. That was XLP. XLE, the energy sector. I get a lot of questions on this one. We've done very well over the last couple of years trading this. Had a lot of official and unofficial long trades here off the lows, caught a lot of that rip back in 2016. Got out of those, have long and short trades in these over the last couple of years. Again, we got bullish back here. I think XOP was the official trade. Got bearish here. XLE was the official short trade. We recently closed that out. So again, a sector that trades well to the technicals, and I've shared my thoughts extensively on the site on this recently. But now where we go from here, this one's sort of grinding around in a big sideways range. It needs to take out these highs. So far, there's that double top high right there. And this seems to be these two yellow lines are the bottom of a pretty significant, support range. We broke it briefly back here in late 2015, early 2016, but for the most part, that has contained all the pullbacks, barring a few brief breakdowns. These two brief little moves below, it has contained pullbacks for years now, going all the way back to even contained the rallies back here in 2010. So this is a pretty key level, and will XLE get down there? Not sure. I think it's going to bounce soon, more than likely. But again, I don't want to get too much into this right now. Let's just say that's not a very clear chart. And that's the weekly chart. That's the bigger picture. Daily, we are at support and we're very oversold right now. So there's probably at least a bounce trade coming up in XLE really soon here. That's a well-defined support level. I've had this level on my chart for a while. We were very overbought, extremely overbought, and we fell to oversold. We're still under the 30 level. We're at 27.13 on the RSI. That's an extreme oversold reading. And as I said, prices can correct in time or price uh, in value, and this one did. It fell. Gosh, what did XLE fall in just short order? I can't grab that trend line, or it moves. It's about 14, 15% in just short order. So that's that. And I was warning for reversal in the energy stocks for a while up here after going long. So that's played out and then some. And I think that at the very least, the risk reward right now is starting to firm up, and they might consolidate. They might not have a sharp bounce, but I think you could go long XLE here with a stop somewhat below that support level. Remember, with this fast velocity, that downward momentum, you may get an overshoot of this level, but especially if the markets do bounce up to challenge or even take out the previous highs, XLE can easily bounce up here to that 70-ish level, possibly more, and that'd be a decent move. So if you took a long somewhere around where we're at now, maybe a little lower, you're looking at 5% upside. Give yourself a stop loss of 2%, 2% below there. I think you're pretty good on that one. Let's see, next one up. So we get down the line is basic materials, and that is XLB. Here's your uptrend line. Same story, intraday pierce, snap back above it. We're slightly below it now. We may need to tighten that line up a little like that, but either way, we're dancing on trend line support right now. XLB. Here's the trend line I have drawn on the weekly chart, so you can see we're challenging that right now, as well as that 40-week moving average. So there's another sector. My point being, here's another sector that's still at key uptrend line support on the important weekly time frame, and that's only a 3% weighting. So as we get down to these smaller sectors here, they don't really have that much of an impact on the S&P 500. As I said, materials is at 3%. Utilities is 2.7% weighting in the S&P. We had a bear flag. Um, yeah, I was getting bullish on these back here. Not super bullish. Again, I like them because they pay a dividend. I thought the selling was getting to be overdone. I still do, as far as pricing in future rate hikes and what the Fed's going to do. And let me tell you this. The Fed, I know the Fed like the back of my hand. We all do. If this market cries foul, if we drop much more, we break those support lines, they're going to back off their plans, for four more rate hikes coming up. They always do it. They've always done it, and of course, we have the new Fed president coming in, Fed chairman coming in. He's not going to want to be the one to start the big crash in the market. So that's the kind of quandary that the Fed is in now. As soon as the market screams and cries, they back off their their bullish speak, if you will, on interest rates, and move to a more dovish stance. So there it is. Looks to me like this flag is played out. So although I thought there was good risk reward back here, and they dropped, but they didn't drop that much. Here's the bull flag right here, or bear flag. There's the impulsive move down after that consolidation period, and it looks like that flag has played out. So from that level there, it dropped another 4%. Um, and I'm starting to see bullish divergence here as well. So there might be a trade there. Here's some trend lines. This yellow trend line we're dancing on right now. Let's see. Clean that one up a little, brighten it up for you. There it is. So utilities are right about at trendline support. They had a divergent high like a lot of other things, and that's why again I'm looking for, at best, another bounce off these trend lines before they ultimately give way. And you know, if they break, my view changes, and we'll start looking at some more short trades. But right now I'm leaning towards a long bias in the broad markets. Real estate XLRE is I've been sticking with the spiders. But I like to use for real estate, I'll just show you this one real quick. There is some support here. It's only a 2.7% weighting. This one, just like the utilities, got knocked out pretty hard because of the rate sensitivity to the REITs, with the whole expectation for rising rates. And again, what surprises me is that was well announced. It was seen coming for a long time, and all of a sudden it just seemed to hit a flashpoint recently. And IYR is the other REIT that's been around a little longer. This is the one I like to look at when I'm doing technical analysis on the REIT sector, coming up on some pretty decent support here. So I think the risk reward is, for the near term, is minimal in the REITs. I think there's probably some good values here to start stepping in if you're an income investor. There's a longer term trend line on the weekly chart for IYR. And then finally, I'll wrap it up with the last sector is telecom XLT. Not a very clear chart to me. There was a price channel here, it broke down. The trend has been sideways to slightly lower. That's a weekly chart. Here's the daily chart. We've had this, year-long plus sideways. It's most likely a topping pattern, but we're a little below it now. We broke below it earlier, snap back within it, we're below it. In fact, we've hit this support zone level 2 right here, this number 65.25. You can see we hit it here and we hit it here. So that's pretty key support for the telecoms. There's only 1.9% weighting in the S&P, so I won't spend any more time on that. It doesn't matter what the telecoms do. The most they can affect the S&P 500 is 2%. So I'll wrap it up there. Hopefully this is useful, and my recommendation is replicate these charts. It's only 11 stocks. Create a watch list, and put those trend lines on your own charts. Use log scaling, and remember the market is a sum of its parts. So if you see, especially the heavier weighted sectors like technology, you see clear breakdowns in those, then it might be time to start taking some of your profits off your longs and your longer term accounts like 401ks and IRAs and stuff, and maybe even short the market if that's your thing. However, if they hold those support levels, we could have another bounce, and that bounce could last months, and it can go up, double-digit returns from here. So it's a scary time, but this is when you want to step in and buy if you are bullish and you think there's more life in this bull market. This is probably one of the best buying ops that you'll see, maybe until this bull market is over. And if all these support levels break and we head a lot lower, this is also one of the best shorting ops that we've had in generations. This is, comparable, I think, the next bear market. I don't think it'll drop as fast as the one from 2007 into 2009. But I think it'll be a long, drawn out bear market, and I think it'll be extremely profitable to trade if you're, well versed with technical analysis, because bear market rallies are just tremendously profitable, as are the legs down. So I would love nothing more than to see a multi-year bear market, chock full of rips and dips, trends measured in the double digits, so we can go long and short. And remember, there's always something that goes up even in a bear market if you don't short stocks. Commodities, like I said, I'm bullish on the ag commodities, and there's other things out there too that we'll find. Precious metals, gold. I already gave an analysis on that yesterday. My thoughts there. So let's wrap it up here. This is probably the longest video I've recorded in a while, but I just wanted to get this stuff out because, again, I think it's a pretty important time right now in the markets. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.